And welcome to Chapter 2, Accounting for Business Transactions for Financial Accounting. Welcome back. This is your professor with the mostest, Nathan Narragon, Professor N's back here. So, you should have already finished Chapter 1, which had basically our basic principles of financial statements, 6 classifications of accounts, GAAP, and basically things increase, things decrease. So this one, we're actually going to put a step further. We're going to start out with actually doing journal entries and understanding the basic principles of debits and credits. Debits and credits are just our terms of stating if it increases the account, decreases the account, and by how. Naturally, we put out a term called normal balance. Normal balance is basically which side does it increase on. Does it increase by debit? Does it increase by credit? Remember, we have to stay in balance. So with this, we're going to look into which accounts actually have this. So our example is the best one, cash. We all have it. We love to use it. So when we gain cash, we increase our bank account. When we pay for something, we decrease our bank account by that cash. If you want to look at that. For us, cash is known as an asset. We own it. So when it increases, this is a natural debit account. So we'll have a normal debit increase. But when it decreases, it's going to decrease by credit. So right here, this is an example of a T-chart. You're going to hear that term also, T-charts. Debits are always on the left, credits are always on the right. So with that being said, assets do increase by debit, they decrease by credit, but notice with liabilities and stockholders' equity, it's a different way around. They both increase by credits and they decrease by debits. This is mostly the natural order for balance sheet accounts of how they increase and decrease. Same thing here, revenue accounts right here. They increase by credit for revenue. Expenses increase by debit. Dividends always increase by debit. This one is naturally known as a contra equity account in some terms, and anytime you hear contra, it just basically means wherever classification it is, it bucks the trend and actually increases by the opposite way. We'll get into a few of those accounts as we move on with this course. Now, an easy way to remember natural balances, I'm actually going to put this here, is a little acronym. It's a neat little acronym. Start off with a good old drug association, DEA. This basically stands for, D stands for dividends, E is for expense, and A is for assets. These first represent natural debit accounts. The classification's there. Next one, LER. This stands for liabilities, equity, and revenue. And all three of those are naturally credit accounts in our 6 classifications. And what does that spell? Crowd goes, dealer. Yes, because we are a dealer of money, we dealer of the accounts. So, as a cool way, this is a nice little acronym. So again, dividends, expenses, assets, liabilities, equity, revenue. If you remember that, that will help you out a lot and figure out the classifications if they're going to be natural debit. So again, this is debit, and this would be credit. And again, notice that DEA is on the left side for T-charts, credit is on the right side, LER. So again, that's another way to kind of figure it out as it goes. Okay, good way to kind of help you out on that. So once we have that, again, here's a nice little graphic. We love graphics. Graphics. We're going to start getting into some transactions. Now, your notes are going to look exactly like mine, and I'm going to fill these in. If you printed these out, fill them in, be awesome for you. So you're going to actually see how these go. But we're going to get into how to actually journalize these transactions. So you're going to notice some of these are from chapter 1, and we're going to explain how they work. So again, Taylor personally invests $30,000 into a business bank account for a fast forward. So we have common stock and cash. Common stock again is going to increase by the $30,000. Cash, we gain that, we take ownership of the cash. That's also going to increase. So you can either look right here where I have the note, or I can go back up here to the graphic, or I can write here. Notice that debit, since cash is increasing, it's going to go and become a debit. Since common stock is also going to increase, it's going to increase by credit. So this is the big thing. Big thing. Highlight this. Do whatever you need to do. Highlight, highlight, highlight. Debits will always equal credits. Ifs, ands, or buts. So if we at least figure out one half of the journal entry, we know that at least the other half has to be the opposite. When we work on these, we're going to usually go debits first. Okay? Since we're dealing with an asset and cash and it's increasing, that'll be the first account. Okay? If it ever shows everything. Boom. So that's going to be my first account is cash. We're going to put it in for the amount that's actually been used, which is $30,000. And it's going to be there. Notice again, debits are always on the left, credits are always on the right. We always do this. So keep an eye on that. And we put in a date if we have a date. Sometimes we don't. Usually you want to put in date. So this time, since this is only known as transaction number 1, we only have one. The reason why we put in dates, the reason why we put in transaction numbers, the reason why we put in post reference if we have a reference document is accountants love to trace. We love paperwork. If we can find exact transactions, we got the paper trail, we are good to go. Okay? So that's the way we want to go. Okay? So since we already know we have a debit and we know that debits and credits must equal, we know that it's going to be a credit of $30,000. We're only dealing with 2 accounts. And since it already stated which account we're using, it's going to be common stock. This transaction right here will be one that you will always use starting off a business. In this whole chapter, whole book, this is how it starts off. The only time this starts changing is in the later chapters, which we're not going to get into. And that's when we actually get into different types of equity. But it still follows the same principle. So, first journal entry, starting up a business. There we go. Transaction number 2. Fast forward uses $2,500 of its cash to purchase supplies. So, the corporation is now taking ownership of supplies. So, we've owned supplies. That's an asset to us. But how did we get those supplies? Well, we used cash. We paid cash. So cash is going down. So again, if you look up here, both of them are assets. Supplies are increasing, so they must be my debit account. Cash is decreasing, so it must be my credit account. So again, I'm going to put in my date. Since we would like to put debits first, supplies is going to be the first part, and cash is going to be the second. with these journal entries, if they're ever dealing with cash, figure out if cash is going up or down, if it's going to increase or decrease. If it increases, it's a debit, so it's going to be my first account. If it's going to decrease, it's going to be a credit, it's going to be my second account. If you keep that, at least you'll get 50-50 out of the journal entries. Since we're only dealing with 2,500, again, debits go before credits. Boom, there's our answer. Okay. So again, if you're having problems with these or have any kind of questions, please let me know and I will help answer those as we go. Okay. Transaction number 3. Now we have fast forward spends $26,000 to acquire equipment. Yay, they acquire equipment. This is going to look pretty much similar to this, because one, they spent. So spent just defines as cash. Cash is going out. So this time they bought equipment. So there's equipment, and it's going to just be for $2,600. Nothing bad, nothing worse right there. Simple way to go. I will tell you this, journal entries are the toughest part, especially chapter 3. But getting the basics of the journal entries is defining what's going on. What am I increasing? What am I decreasing? What am I taking ownership of? What am I losing? Why did I do this? So if you can answer the why, it helps out a lot. So these two right here, these two graphics that are in your notes, one gives basically common transaction terminology. So these I would actually look at, trying to know, because it tends to pop up, especially like on the on account parts right here, and it actually will tell you kind of what they go with. Again, if we see earned, it doesn't have to be fees earned. That's basically our revenue. And then payables, again, that's a liability. You gotta kind of know this, so kind of go over these, kind of see how they're working right now. The other little thing that you see is known as the chart of accounts. Accountants love chart of accounts. If you use any kind of software that's bookkeeping state, like QuickBooks or Sage, they are going to be having a chart of accounts. Chart of accounts are usually a little bit easy to understand. First off, they kind of mimic the financial statements. They will always start out with balance sheet accounts, so assets, liabilities, stockholders, and they will have the end with the income statement, so revenue and expenses. So in order to read these, usually you're going to judge by the numbers. As you can see, all the assets start with 1. So cash, accounts receivable, supplies, prepaid, land, and office equipment. Notice that they also flow basically what they're going to appear on the balance sheet. They repeat the same thing. Liabilities, you have accounts payable, unearned rent. Again, you see number 2. They all start with 2. Equity starts with 3. Have all the 3s. Revenue, so forth and so on. Okay. So now we're starting to get into kind of our flow, you can say, of how the accounting cycle works. The accounting cycle starts off with some kind of transaction occur, some action that happens. The next section is actually journalize, which we're doing right here. We create our basically T-chart. We post entries to ledger account or T accounts. That's how they call them. As you can see right here, step 3. So step 1, transaction. Step 2, we actually journalize the transaction. We start figuring it out. We put it right here, post it to the ledger. We're analyzing, we post the ledger. And the last part is preparing another statement that's not of the major 4, but it's a very important statement to know because it does help figuring out what goes into what account. And that is going to be the trial balance. So we're going to get that in just a sec. Let me just show you what are T-charts. T accounts. Yay, T accounts. So I think somewhere I may have done too many extra spaces when I enter that in. I'll do that because it's kind of off a little bit. Okay, there we go. A little bit better. Alright, so T accounts. These are the fun parts. I will tell you this. This is like one of the most awesomest tool to have to use because it helps you out so much. So with the T chart, we're actually going to list what has happened. If it's increased, debit. For this example, this is cash. If it was an expense, or we basically paid with cash, we're going to put on the credit, and then you're going to take the actual total. Now, so the total debits was 36,100. Total credits was 31,300. We subtract those two, and it will give us a positive amount. And the positive amount means that it still has money in it, or basically our debits were greater than our credit. So with that being said, when we find a balance, we put it right here into which one was the greater side. And then we continue next month or next year, so forth and so on. But we have our balance. It keeps going. Okay? Ledger accounts will do the same thing. They're going to actually take the journal entry you've created. For here, it's a little bit harder to see, but it's actually prepaid insurance and cash. And basically we made it looks like we paid for some insurance. So again, cash is credited, prepaid insurance gets debited. Again, we'll get into prepaids a little bit later on. But this graphic basically shows you the flow. When we take the journal entry, we're going to go find the account, their actual general journal account, and their individual ledger accounts. So we're going to post it from the general journal to their individual ledger account. Notice that says account prepaid insurance. And we're going to basically put it just like it is. So 2400, 2400. 2400 here in cash, 2400 here in cash. Notice that it does have post reference. These are the account numbers. So it's not necessary we need them for this one, but we do use that if we have like a big company. So kind of like Walmart or Amazon, they may want to do it just to get proper tracing. But really, this is only because this one shows page number as our reference, so we can actually trace. Again, we keep our dates, so dates stay the same, boom, boom, and then we keep our balance. So right here, this is our only transaction for our insurance, stays 2400. Cash has a lot of transactions, so right now with the credit of 2400, we find out that their balance currently is 3,500. So that the ledger and the T-charts basically will run the same. In fact, it's a good balance. So if you did the T-chart and the ledger and they don't balance, that means one of them is missing something. So it's a good way to go back and check yourself. We always want to do that. Okay. So again, the ledger is a collection of all accounts for an accounting system. A company's size and diversity of operations affect the number of accounts needed. Small businesses don't need very many accounts, very specific. Larger ones want more specific. So that will definitely affect. That's why we like post reference when it's a larger account. We're not going to have that because we're dealing with smaller accounts. Okay. So once you've done all your T charts, T accounts, everything, we're going to list them out in what is known as a trial balance. This is known as a unadjusted trial balance because we haven't done any adjustments, but we actually do adjustment entries. This is in chapter 3. We're not in there yet, so no worries. With this, we're going to show all the accounts that have or will have a balance. Some we don't have to, I don't have to show accounts receivable since it's 0, but we're doing it just because you can see that's happening. So what we do with these, we're going to take whatever is in the T-chart and we would actually post it right here. Notice this is a different count than what it's shown up there. That's because we're using fast forward's example again and their actual trial balance. But these are actually the ending balance of all the T-charts. So this tells me that the debits outweigh the credits this month of 4,275. Notice again, they typically run the normal balance. So all our assets are debits, all of our liabilities and equities credit, dividends are debit, again revenues are credits, and expenses are debits. If these are not like in their normal balance, that is a big red flag to say, hey, we need to audit this account to see what happened. Did something get mixed up? Did it get replaced? Okay. Our big goal with trial balances is to make sure that they completely balance. So this has all of them, all of our balance sheet, all of our income statement, and notice how these counts run exactly like your chart of accounts, exactly like it. Okay, so if you see a chart of accounts, your trial balance should actually follow the list down. Okay? So again, there it is, list them all: assets, liabilities, equities, dividends, revenue, and expenses. Boom, there you go. So, and basically you need to know this for any exam. Connect tends to use the same thing. It always follows these categories this way: balance sheet. If you want to go dividends, then revenue and expenses, income statement. Okay. So the problem is, even though that they equal, does not mean that they are correctly recorded. So right here, just because they're equal, does not always mean that it's true. Again, people can fudge the numbers a little bit, or they can get the right ones, but they put it in the wrong columns. Numbers do change. So even though it's correctly, there's always times to retrace and figure out if something just doesn't look right. So if you know that equipment, we actually bought equipment for $26,000, but it shows up in here like $20,600, and we reported the same thing for the credit, the cash, it's going to balance still, same numbers, but we know that something's off. So it's not always going to be foolproof, but I mean, it's a good thing if they do balance. It really does show a lot. Okay, so let me see. So from this view, we can really easily calculate net income if we wanted to by actually taking out the numbers. So we actually have 5,800 plus 300 minus 1,400 minus 1,000 minus 305. So basically we just took right here, there's our income statement right here, and we just took numbers like they are. So 5,800 plus 300 minus 1,400 minus 1,000 minus 305. Boom, there's our net income. Guarantee you're going to get that. So with that, we end up with our ratio. Yay, ratio! Woo, ratio! We love ratios. So our debt ratio, again, is this one basically wants to see, can we pay our debits? Are we too high? And if there is, then the company will not be able to pay its debit. And that's not good for investors. If you think investors are going to invest in something that they know if some tragedy happens, they can't pay off their liabilities, means I'm not going to get money. So I'm not going to invest into it. So we want to make sure that it is where they can pay their basically liabilities. So Again, the formula is basically total liabilities divided by total assets. And this is the only ratio we have here. But be careful, we always go back to other ratios. So you gotta always remember your ratios. Here, this is just a nice little graphic just to show you all different account types that go with those certain items. So assets, you can see there's quite a few that we're going to get with. So anytime you see receivable, prepaid, those are going to be part of that. Liabilities, if you see payable, any accrued liabilities, and unearned revenue, we're going to get into that one in the next chapter. Excuse me. And then the equity accounts, again, common stock, revenue, expense, dividends. Notice that still shows the formula, which one gets added and which one gets subtracted. So again, chapter 2 and chapter 1, because there's so much information that's the basic building blocks, we do have fill in the blank and a little bit of multiple choice. So again, before you keep going with this video, if you like to pause it, try to answer it before I go through everything, go for it, and then you can see if you're right or wrong. And if you are wrong, go check, see what happened, figure out why you picked that. That's always a good, helpful hint. So, first off, balance of accounts. Debits, basically got, if you subtract the credits, you should be at 0. They balance out. They always should equal together. Assets will always have a debit, no more balance. Dividend account has a credit or debit. Debit balance, dividends are debits, revenues are credits, expenses are debits, and liabilities and retained earnings accounts normally have, oh wow, a credit. So those are the easy ones right here. Here, determine which type of account is being described in each of the following definitions. Now these are a little bit tougher. So, resources of the company. Well, that is going to be an asset right off the bat. Owner's rights, that's equity. Equity. Pikachu. Pika. Sales of service of products, that's revenue. Accounts owned by the company are owed, that's a liability. And then consuming assets or services in order to produce revenue, that is an expense. Basic definition of expense. Next, determine which of the following accounts is an asset, liability, revenue, expense, or equity account. So again, classification. Equipment's always assets. Utilities incurred and paid. There's my expenses. Unearned revenue. This is one of those tricky ones. This is a liability. So we basically owe someone a good or service with this one. Sales, of course, is revenue. But that one we're going to get into a little bit more in depth. But if you ever see it, it is a liability for unearned revenue. Just something that we have yet to perform the service, but we got paid in advance. Okay. Common stock is equity. This one, again, same thing. Salaries payable, we see payable. That immediately should be a liability. Cost of sales, the cost. So cost is just another fancy word of expense. Common stock is equity. Investments, we invest. We're owning part of that security. It's an asset. And fees earned is, of course, we earned it. So revenue. Okay. Question 4 brings us, would it be a natural increase by debit or credit? Of course, common stock is naturally increased by credit. Stockholder salaries expense, it's debit. Sales is revenue, and it'd be credit. There you go on those. So question number 2. This one we're going to have to go back and forth a little bit, but this one is our practice problem. Notice we've already did a few of these. So, in fact, we did the first 2 already. up above, way up here. So those two right there are, we basically did transaction number 1, transaction number 3. I think this one probably falls in that problem also. So those two, boom, we're going to go ahead and fill out. 1, 2, 3. So there's those two. Same thing as above in our examples. So again, transaction, which transaction, that's going to be our date. If we do have a date, we need to put the month and the day. Account titles, you have your whichever accounts they are, and then amounts. Remember, big key, debits must equal credits. They must balance out. So you shouldn't have something bigger than the other. Does not work. Accounts are all about balance. We're OCD about that. So, transaction number 3, we actually purchased supplies worth the $7,100, and we did it on account. So since it's supplies that we now take ownership of, that is going to be our debit. Now, our credit right here says on account. So it should be accounts payable. You can abbreviate with AP. And again, just debit credit. So only 2 accounts makes life easy. As long as we put which accounts first, it's always going to be debit credit. If we know it's only 2 accounts, you can go ahead and put debit credit. It's going to be the full amount. Okay, transaction 4. Fast Forward provides consulting services and collects. So we collected money, we received money. So we know we're affecting the cash one. Cash is going up. Why didn't cash go up? Well, we provided a service. So again, if we provide a service, that is a revenue account. So my journal entry is going to be cash. Since cash increases, it increases naturally debit. It deals with revenue. Revenue is a natural increase in the credit column. So since our revenue increased, it will be naturally credit. Again, big key, if you can decipher that's only 2 accounts, you can put the whole amount as debit credit. Then it's just figure out which account is being used and what account. Okay. Again, I would suggest probably look up in the chart of accounts and see if those accounts are on there. And if they are, it will automatically tell you the classification. Okay. Next one, we paid $1,000 in rent. So again, we paid rent. So paying rent, we definitely know cash is going out. So cash is our credit account. So that means we're paying rent. Rent expense will be the next account. And again, since we're only doing 2, debit credit. Alright. Question 6. We now pay $700 to our only employee. Our only employee finally gets paid. So that's again like a salaries expense. So again, it's an expense, cash went out, and we put our debit and credit. 7. We complete the job and bill a client for $1,900. Now notice that these transactions, I will tell you right away, are related to chapter 1. They're the same transactions we did, except for a few extra new ones, but most of these are exactly the same. So you can actually see how they roll. So we paid on, we billed on account. So since we billed on account, we have not yet received cash. So since we haven't received cash, but we know we're going to, because we billed it to a client, that is going to deal with accounts receivable. And why did we bill the client? Well, we billed it for revenue. So we got revenue in. We did a service. So again, debit $1,900, credit $1,900. Transaction 8, we received $1,900 on account. So now this person is paid. Well, for this, we know it's on account. Where on which one is it working with? Well, it's AR. So with this, what did we receive? This is what you should look at every transaction. What did we receive? Well, we received cash. So cash is an asset. It's being debited. Where did the cash come from? Who owed it? Well, we did do a service for that to earn the cash, but we already recorded the revenue. We recorded it to AR. So since it's being paid on account, accounts receivable is that because it's coming from a client. It's coming from someone we billed. Okay? Not someone that billed us. If it's someone that billed us, then that's accounts payable. So you gotta watch out for the accounts that are being used and how the lingo is. So again, this one we received it. So we received cash. Here we paid cash. Same thing has an account, so it's either accounts payable or accounts receivable. But here we receive it, it's dealing with accounts receivable. If we have to pay it, it's dealing with accounts payable. Okay. So again, that means cash is going out. Accounts payable gets hit for the same 900. Okay. Number 10, we paid 200 to its owner. So we're paying the owner. Anytime we pay the owner, again, that's a dividend. So dividend is a natural debit. It's going to increase by 200. Since we paid out cash, again, it's being credited. Notice which account we tend to use the most. It is the cash account right now. So you're going to see cash either increasing or decreasing. And this will basically define if it's going to be a debit or a credit. Okay. 11, we received 3,000 cash in advance for providing consulting services. Alright, so this one is a definition of unearned revenue account. So that is an unearned revenue because we have received cash in advance. So cash in advance, but we have not yet provided the consulting service. So with that, cash did increase, and now we have unearned fees. They want to call it unearned fees, but it can actually be unearned revenue. You can put unearned consulting revenue if you want to get more specific. But again, it still follows the same thing. Cash is increasing. Unearned is going to be for the 3,000. Again, unearned revenue, it's mostly is we got paid in advance for the job. So if we don't perform the job, we still owe that person their money back. So we have to refund the money. So we want to keep track of how much we have to refund. 12, fast forward pays 2,400 cash for a 20-month insurance policy. Alright, so this one right here is known as a prepaid. We basically prepaid for advance year, 2 years on the insurance policy. So we have not yet used the whole insurance policy when we do this. So we cannot recognize the expense until it's been used. So with prepaids, this is going to be a big one in next chapter. When you see a prepaid, they are of course going to get debited. They are known as an asset. So prepaid insurance or prepaid rent, prepaid security deposit, whatever you want to do prepaid for, is going to be debited for the 2,400. But cash again is decreasing, so that's also by 2,400. Last one is fast forward pays $305 in cash for utilities. So we're paying cash for utilities. So again, that's an expense. So utilities expense gets the 305, cash gets the 305. Here, once we've done this, you can actually go to the T charts and actually fill in T T accounts, T charts, they're all the same. Looks like a T. Awesome. So here I can go right here, go cash. I see 30,000. That's a debit. Go here. I would actually put 30,000 here in cash. So notice I can't really write in here. So plus it won't let me. So right here I would put 30,000. So insert. Let's see. Text box. Oh, I love that. And then of course it's like that. But with this, so here put 30,000 right there for cash, and then I'll look at the other account, common stock. So I'll find common stock, and I'll do the same thing. For me, I have to do it this way, but for y'all, I would just say print this out and actually do it. It's right here, 30,000. Boom. That's my first journal entry. Now, normally for Connect, you will have dates of when these happen, but we're just going to do it very simple. Same thing. Go to the next. Equipment 2600. So insert. Hit when I actually had it, and then it goes away. So let's go. Just insert, simple enough, text. And course, fixed position. And then equipment gets the 2600. And cash gets the other one. So insert, text box, boom. And you notice that now it's on the credit side because it decreased. And you will go through this, through each one, just keep going, going, and going, and going, and going, until you've completed all of these. So all of these get completed, 2600, 26,700. So this one I would probably suggest to look at the homework video later on with the T-charts. But you want to keep going on and on and on. So if I want to take, well, I want to take the equipment one since we only have one transaction. So at the end, once you finally put all the transactions in, you want to total them up. So 26,000. So this would be my total. I would draw a line. It won't let me. Yay, line. Just do it this way. So draw a line, put the total. So here, if this was the only two that I had, I would actually have drawn a line. Right here. And I would have done the total. 30,000 minus 2,600 is still 4,000. And that will have been the ending balance of the cash. Notice again, there's more cash accounts, so don't follow that to a T. That's $4,000. We still have to put in all these other cashes. Once you get done with that, now it's creating the trial balance. So with that, you start off with the header. Header is always the company first, then whatever document we're doing, so trial balance, and then for whatever year we're using, December 31st, 2016, and then we fill in from our T-charts the actual accounts. So what I would like you to do, since this is actually shown on the video, is make sure your T-charts balance to these accounts. If they don't, that means you missed one of the journal entries. Again, they should balance 45,300, 45,300. Okay? So, again, you can collect net income very easily from this. Take 6,100 minus 700 minus 1,000 minus 305, and there you go. That is it. So, if you have any questions, let me know about Chapter 2. Send me an email, give me a call, whatever you need to do, just let me know. Email is preferred. Always send like pictures of documents of what's going on. Okay? So that's it for Chapter 2. I will see you later for Chapter 3 and for the homework.